Welcome, everybody. Really excited. We have Rick Edelman today with us today. I'm just going to do a brief intro, not going to do him justice, but just to do a really brief intro. He's the founder of the Digital Assets Council of Financial Professionals, The Truth About Your Future, and the Funding Our Future Coalition. Made multiple trade publications, have named him one of the most influential people in the financial planning and investment management profession. He's a leading financial educator and also a champion of improving financial literacy. He's among the 100 most important radio talk show hosts in the country, and his show has actually been on the air for more than 30 years. And he also teaches personal finance, first at Georgetown University, and now he's a distinguished lecturer at his alma mater, Rowan University. Good thing is, Rick is an expert on digital assets, which we're talking about today, but even better, he's a great guy. So I'm going to send it over to Rick, and he can take us away.
William, thank you so much. I appreciate the very kind intro. It's great to be with you. I've got a lot of content to share with you on the subject of digital assets, about 185 slides to blow through in a really quick period of time. So we're going to get right into it. We're going to start with three polling questions. Let's level set where we're all at here. So Nora, why don't you bring up the first polling question? Does your firm allow inclusion of digital assets in client portfolios? Yes, no, but you're considering it, or no, and you don't plan to. So let's take a few seconds and vote. Here's the answers. A third say yes, you are allocating to client portfolios. 50% aren't, but are planning or considering doing it. Only 14% are saying no, you have no intention of getting involved. Great, let's go on to the next polling question. Do you personally invest in digital assets? Yes, no, but you're thinking about it, or no, and you don't plan to. Let's take a few seconds and answer this. The numbers are similar, a little bit lower. 25% of you are, 31% considering it, 44% have no plans to invest in digital assets now or in the future. And our final polling question. If your firm does not allow investing in digital assets on behalf of clients and or doesn't plan to in the future, what are the reasons why? What are the impediments? Check as many of these as you like. Lack of buy-in from senior management, lack of demand from clients, lack of interest from advisors, compliance risk, market volatility, fear of scams, or other reasons. Check as many of them as apply. Pretty clearly, it's compliance risk is the most common reason that firms are not engaging. We're just concerned that there's not enough regulatory clarity to move forward. The single biggest reason. The others are all pretty much similar in the responsiveness. Not too many worried about scams, and I think that makes sense. If we know what we're doing, we know how to avoid scams. So I think that does make some sense. Well, that's terrific. I think that gives us a good framework. Thank you, Nora. For laying out our conversation today. Let me jump right to my slides. And I'm going to blow through these as quick as possible so we can get to some Q&A. You'll be able to ask questions in the Q&A box at the bottom of your Zoom tab, and we'll go from there. The goal here is to help you deal with the concept of crafting a compliant, that's a key word, isn't it? A compliant corporate crypto strategy. I've been involved in the crypto space for a decade now. I first was introduced to Bitcoin in 2012, and I've learned over this past decade that this is a pretty impactful technology, but most in the financial services industry are really not familiar with it and don't really understand how to go about figuring it all out. And that's what we're going to try to cover here today for you. We're going to begin with the question, why is the blockchain such a big deal? and we're going to start by just looking at what the Bank of England said. They said that blockchain technology could transform the entire global financial system. The technology is going to grow 10x over the next 4 years, adding nearly $2 trillion to global GDP by the end of the decade, according to PwC. Virtually every bank in the world is busy developing blockchain tech. JP Morgan Chase says it's going to save banks $120 billion a year. NASDAQ says it's going to let capital markets operate more efficiently with greater transparency and security. So yeah, it's a big deal, but what is it? Well, let me see if I can't explain it for you briefly. Blockchain is more formally known as DLT, distributed ledger technology. Well, to understand a distributed ledger, let's first take a look at our current ledgers, our traditional ledger systems that we use personally and in our businesses. You're familiar with a ledger, even if you're not normally using that word. Your bank book, your checkbook is a ledger. You record your deposits and withdrawals. Businesses use ledgers to record income and expenses. We're all using ledgers all the time to record, everything going on in our business, inventory of our products and income and expenses, assets and debts, deposits and withdrawals. The problem with ledgers, so think about it, when you create an Excel spreadsheet or when you use your bank checkbook, you're the only one who has access to it. Nobody gets to see your Excel spreadsheet unless you give them permission to do so. You share it with them or send it to them. With blockchain technology, that ledger is open to everybody because it's not maintained on your computer. It's stored on millions of computers all around the world. And that makes it available to everybody to see. All you need is an internet connection. See, when you have a private ledger, you can manipulate the data. If somebody wants to look at your checkbook and you show it to them, well, you could frankly create a duplicate checkbook with fake entries. You've heard the phrase, 2 sets of books. That's why Al Capone went to prison. Well, you can't manipulate data on a blockchain. The data is immutable. Once it is placed onto the blockchain and authenticated, the data is permanent, can't be changed or copied or erased. And because traditional ledgers can be manipulated, we spend a lot of money verifying and confirming their accuracy. We hire accountants, and then we hire auditors, and then we hire government examiners, all to make sure that the ledgers are representing legitimate data. Makes it really cumbersome and expensive to use, but blockchain technology is virtually free. This is revolutionary. Blockchain allows businesses to operate faster, cheaper, safer, with greater transparency and inclusion, and it is revolutionary. This is why the president last March issued an executive order calling on the federal government to responsibly develop and promote the use of digital assets. Jay Powell, in talking about a central bank digital currency, a digital dollar, said in March, we're going to get it right. Janet Yellen, the Treasury Secretary, called the technology transformative. Maxine Waters, the chair of the House Financial Services Committee, says we're in a global digital assets space race, and America can't be left behind. Elizabeth Warren agrees with her and says it's time to do a CBDC. But on the other side of the political aisle, Ted Cruz said this summer, I believe in Bitcoin. I want Texas to be the oasis on planet Earth for Bitcoin and crypto. So this is one of the few subjects that gets broad bipartisan support. And it's not just a US thing, it's a global thing. Christine Lagarde, president of the European Central Bank, said this spring that her preference is to see a digital euro in just the next 2.5 years. This technology, most importantly and fundamentally, eliminates the trust industry and creates the authentication industry. This is a big deal, so I want to spend a moment explaining to you what I'm talking about here. And the easiest way to do that is to talk about your home. We're all dealing with home ownership. We've all at one point in our lives bought houses, sold houses, and you know how the game works. Your house, a physical asset, is physically represented by the piece of paper, a deed. And when you decide you want to sell your house, you have to sell it to a buyer. Well, picture that these are 3 separate blocks of data. You, the seller, describing yourself and your ownership of the house. Imagine putting that information in cell A1 on an Excel spreadsheet. And the buyer, who represents that they want to buy the house and have the financial ability to do so. Let's put them at cell C1 on that spreadsheet. And the deed itself will go in between the two. The deed is the item being transacted, being moved from the seller to the buyer. So we've got cell A1, B1, and C1, three separate blocks of data, and we're going to link them together as though they are links in a chain. Blockchain. That's where the word comes from. It's not really very complicated at all. The problem in this transaction, though, is that the buyer doesn't really trust the seller. Think about when you bought your house and the seller said, I'm willing to sell it to you. You had to ask, does your seller really have ownership of that deed? Do they have free and clear title? You weren't so sure. So what did you do? You hired a title settlement company to do a title search. And then you bought title insurance. Meanwhile, you're trying to get a mortgage and you're attesting to the mortgage company that you can afford this house, and they didn't really trust you. So what did they do? They made you verify it. You had to give them reams of paper, your income, your expenses, your debts, your net worth, your assets, to demonstrate to the bank that you really are creditworthy and deserving of this mortgage. And all of that process is because at the end of the day, we don't trust each other. And yet we work in a trust economy. We're relying on trust that you'll deliver what you're promising. And this is why we hold back. And this is why you gave your deposit to an escrow agent, not to the seller immediately. And until the seller did deliver the deed, you're not going to transmit your money, because trust only goes so far. What if, on the other hand, we were able to authenticate cryptographically those transactions? We would no longer need that trust company. We wouldn't need the escrow agent. We wouldn't need any middlemen. We wouldn't need an intermediary. The trust industry is filled with intermediaries, people who are in between the buyer and the seller. They don't do any good. They don't really add to the value of the transaction, right? The value of your house didn't go up because you spent thousands of dollars on title insurance and a title search. You didn't have the value of your house go up because you paid thousands of dollars to the bank as a middleman for the mortgage. There are middlemen in every industry, commercial banking and securities, real estate agents, lawyers across the board. We're talking 10 million US workers, mostly white collar jobs, representing about 20% of our GDP. This is a big deal because blockchain technology can digitize and automate their services. We no longer need any of these people to engage in a transaction. In the future, you'll be able to buy a house and move in the same day you sign the sales contract, just like you can walk out of a grocery store with a loaf of bread minutes after buying it. The financial planning implications of this are huge, and so are the investment opportunities. The first invention using blockchain tech, of course, was Bitcoin, which was launched in 2009. Bitcoin is a payments technology. There are lots: credit cards, debit cards, PayPal, Zelle, Venmo, Square. These are all payment technologies. Bitcoin is simply the newest form of payment technology, and it is superior to all of the others. And I'm going to give you just one illustration of the literally millions of commercial applications that are available using this technology. Cross-border payments. You're probably familiar with this. It's a $4 trillion business worldwide. Companies and individuals moving money from one country to another. The individual level, it's about 20% of that number, $800 million a year. People moving money from one person to another, typically immigrants who want to send money back home to mom, who still lives in what my grandmother used to call the old country. If you're going to move money from one country to another, you've got to use the global banking system, the SWIFT system, or you got to send the money via Western Union. It takes on average 5 days and costs 6.5%. You can actually fly the money to New York to London faster than you can wire it. But you can use Bitcoin and get the money there in 10 minutes virtually for free. This is transformative on a global scale. And one other really interesting aspect of Bitcoin is that it is extremely divisible. Our dollar is only divisible to 2 decimal points. 100 pennies equals $1. And we go to 0.01. That's as small as a transaction can possibly get. And then those of us old enough like me to remember penny candy, that's the cheapest anything can be. But with Bitcoin, it's divisible down to 9 decimal points. Yeah, it takes 100 million Satoshis to equal 1 Bitcoin. And this allows people around the world who don't have access to a bank account to engage in economic transactions for the very first time. The United Nations says nearly 1 billion people on the planet are living in abject poverty. They live on $1.20 a day or less. For that kind of a person, a penny is an awful lot of money. Imagine being able to do a transaction that's a fraction of a penny, enabling people who don't currently have access to a bank account to engage in financial transactions for the very first time. We take it for granted here in the US because we've all got bank accounts. Our paychecks are wired directly deposited into our bank. We use automatic bill pay. The bank holds our cash for us very safely. We have FDIC to insure it. We don't give it any thought. And having access to that bank account gives us the ability to build credit. It gives us the ability to borrow money, to start a business, buy a house, rent a car. You can't do any of those things if you don't have a bank account. And there are 1 billion people in the world excluded from the banking system because they don't have enough money to afford a bank account. And we're not just talking about people in Africa and Southeast Asia. 7% of US households don't earn enough money to have a bank account. And this is why it's such a big deal that millions of merchants all around the world accept digital assets, Bitcoin and Ethereum and others, in payment for purchases with goods and services. 24 million merchants on PayPal alone. Walmart's installing Bitcoin ATMs at all of its stores. You can make charitable donations in Bitcoin, political contributions. Colorado lets you pay taxes in Bitcoin. Many colleges are letting you pay tuition with digital assets. And then there are computing technologies that this allows you to do: file storage, graphics processing, cloud computing, digital apps and tool sets. It's also useful in smart contracts, self-executing legal agreements. You only get my money when you do something for me. In other words, we have been able to use blockchain technology and use it as an escrow agent without any human beings or lawyers involved, eliminating the need for a trusted third party. It also serves as digital money, stable coins, which have the value of $1, CBDCs, which are government issued stable coins. Already governments around the world are doing this, most threateningly, China. Its digital yuan is already in use, not only in China, but in Africa as well, threatening the US dollar as the world's reserve currency. I encourage you to read the Hoover Institution's 200-page report on the urgency of our federal government creating a CBDC. Condoleezza Rice wrote the foreword of that. You can get that paper at hoover.org. It's also used in decentralized finance, peer-to-peer financial services. Imagine buying stocks and bonds without having to go through a broker or even the New York Stock Exchange. Useful in asset management, digital exchanges, rewards and loyalty programs, crowdfunding, lending and borrowing, prediction markets, insurance. All of this can be done without intermediaries. So I love it when people ask, is Bitcoin a fad? Well, its transaction volume is $3 trillion a year, 3 times more than American Express. Coinbase is the #1 downloaded app at the iPhone store. They've got more account holders than Schwab, E-Trade, TD Ameritrade, Interactive Brokers combined. And individual investors worldwide are now owning Bitcoin, 300 million of them, including 20% of US adults. Millennials, 83% of them, of millennial millionaires, own crypto. And teenagers, every year, T. Rowe Price does a survey they call Parents, Teens, and Money. They've been doing this for more than 20 years. This year, for the very first time, they asked questions about crypto. And they said to the teenagers, if we gave you $100 to invest, what would you buy? 57% said they'd buy crypto. Only 38% said they would buy stocks. 51% of teens say crypto is the future of investing. Their attitude is not likely to change when they become adults. Billionaires are buying crypto, major corporations, including old standbys like Mass Mutual, endowment funds, pension funds, hedge funds are investing in crypto, family offices, 3 out of 4 of them. Half of the nation's financial advisors personally own crypto. Boston Consulting Group says that investors have $1 trillion in crypto assets. It's so pervasive now that the IRS has moved it to the very top of the 1040. Right after you provide your name and address, the IRS asks, do you have any financial interest in any virtual currency? They're convinced millions of Americans own it and are not reporting their taxes properly on it. Begs the question, how much should I invest? Well, my recommendation is simply 1% of your allocation. That's it, a tiny 1% allocation to your portfolio. This is what I talk about in my best-selling book, The Truth About Crypto. People are sometimes surprised when they hear me say that. If I'm such a big fan of this technology, why only 1%? Well, two reasons, really. First, the price history of Bitcoin shows that there are massive opportunities for huge outsized performance. Bitcoin is the best performing asset class in history, the best 2, 3, 5, 10-year, and since inception returns. It's up over 40 million% since inception. That party's over. We'll never see that again. But the opportunity for outsized returns is huge, which means you don't need a big allocation to enjoy a material impact on your portfolio. So one reason for only 1%, it's like sugar. You don't need a lot of it to improve the taste of your cookies. The second reason, though, is that this is still very new and untested, unproven, with a lot of regulatory uncertainty. All this still could blow up and end badly. It has already for some. If you invest only 1% of your portfolio, you might be annoyed if it becomes worthless, but it won't be financially devastating. So I recommend a low 1% allocation. That's plenty for your portfolio. I'm not alone in saying this. Yale did a study in 2018, and they said even if you think Bitcoin will outperform by 200% a year, you only need 6% in the portfolio. And the CFA Institute released its report, and they said 2.5% to 5%. So pretty much everybody who's been studying this stuff for a long time is in agreement. Low single-digit allocations is plenty for your portfolio. And Bitcoin is really just the beginning. The big thing right now, tokenization. Thanks to this technology, we can tokenize anything. The first condo building in Manhattan was tokenized in 2018, $30 million building. Wouldn't it be really cool to buy the Empire State Building? Multi-billion-dollar asset, which is why you don't own it. It's too expensive. Besides, it's illiquid. Once you own it, what are you going to do with it? You can't easily trade it like you can shares of IBM. What if we could take a piece of real estate and tokenize it? Take that $30 million building and slice it into 3 million slices of $10 each. See, in the stock market, we take IBM worth 100 billion, we slice it into shares that are $100 a piece. That's what we do on Wall Street. We take stocks, we turn them into shares. In the world of blockchain, we turn them into tokens. Tokens, shares, slices, it's all the same thing. The bottom line is we take an expensive, valuable, illiquid asset, we demonetize it into individual tokens that are highly affordable and tradable. Now they're liquid, just like stocks. This is a big deal. They're already tokenizing in Dubai. The St. Regis in Aspen was tokenized 2 years ago. By the way, if you own the token, you not only own a piece of the hotel, when you check in, you get a room upgrade. This is a big deal because the real estate market is 3 times bigger than the global stock market. Look at all of that wealth that is locked up, available only to super wealthy investors, sovereign wealth funds, endowments, pension funds, institutional investors, billionaires. Imagine if ordinary individual investors had sudden access to this global real estate market. Look at the incredible investment opportunities that would ensue. It doesn't stop there. We can tokenize anything. Rare art, exotic cars, old wine. Everybody's tokenizing these days. And the most unique type of token, NFTs, non-fungible tokens. Well, to understand what NFTs are, you got to understand what fungible is. Fungible just means commonplace. In other words, if I lend you $1, you need to repay me $1, but you don't have to repay me with the same exact dollar. All dollars are fungible. They are identical. They're commonplace. $1 is $1 is $1. But if I lend you my car, you better return my car because my car is non-fungible. My car is unique. The dents, the mileage, the trash in the back seat, that's unique. So we want to make sure we're dealing with some tokens that are fungible, like shares of tokens of an office building, versus non-fungible tokens that are individual pieces of art, collectibles. Maybe you've heard of crypto kitties. These are digital pieces of art. They only exist on the internet. Each is unique, and collectors enjoy buying them. Maybe you've heard of crypto punks or the Bored Ape Yacht Club. Thousands of digital images that only exist on the internet, which are capturing billions of dollars of investor interest. Maybe you've never heard of them, but I'll bet you've heard of the NBA. The NBA issues NFTs that are called Top Shots. Remember the old Topps baseball cards we used to collect as kids? Well, now they've gone digital, and the NBA offers them. So does football, baseball, and hockey and soccer. They all are offering NFTs of your favorite players, and they're not just photographs, they're video images with huge amounts of statistics. You gain access to private meetings with the athletes and the teams, special upgrades once you're in the stadium. These are huge opportunities. It's also happening in the world of fashion. Gucci, Burberry, Tiffany, all launching clothing, jewelry that only exists digitally. Why would somebody buy a digital jacket from Burberry? So that they can wear it while they're playing a video game. Yeah, their avatar dresses up in this clothing. And when they're done playing the game or they're tired of the clothing, you can sell the clothing to another player or take it with you to another video game, something that has never been able to be done before. You're not only playing the game, you're now an owner within the game, creating economic incentive that never existed before. We're able to tokenize event tickets. You'll now be able to go to that concert or baseball game with a non-fungible ticket that exists on your phone. In the world of entertainment, we have VR and AR, advertising using crypto, content creation and distribution, gaming, gambling, social media. In the world of music, you've heard the news. Springsteen sold his music catalog for $500 million. Dylan got $400 million. Stevie Dix $100 million. David Bowie, Sting, Phil Collins, Justin Timberlake. The list goes on and on and on. Paul Simon, Pink Floyd. They've all sold their music for hundreds of millions of dollars. Guess what the corporate buyers are? Guess what they're going to do? They're going to take that music and tokenize it. Imagine every time you hear Born to Run on Spotify, you'll be able to earn a piece of the royalty. And how about your driver's license? Why is that a piece of paper laminated in your pocket? We're going to turn that into an NFT where it will be stored safely and securely in your digital wallet. Easy for you to distribute and transmit. Same with your passport, medical records, employment and academic records, deeds and titles, safety records. Your house will be able to be tokenized. Retirees looking for more income, their house is their biggest asset. Let's take that $1 million house and split it into 1 million slices of $1 each. Sell as many of them as you want to generate income. People will buy your tokens because they want to invest in the real estate of your community. You'll even be able to tokenize your salary. Wouldn't it be cool to own a piece of the action of your favorite Broadway star, Hollywood celebrity, athlete? Instead of just being a fan of your favorite baseball player, you will be able to own a piece of their contract. As their career progresses and they make more and more money, you'll benefit economically as well. You won't merely be a fan, you'll be an owner. We can tokenize everything. And all of these tokens are the gateway to the metaverse, which will be a $5 trillion business by 2030, says McKinsey. That's equal to Japan's GDP, the third largest economy in the world. I haven't even mentioned DAOs, the newest form of legal structure, C Corp, S Corp, LLC, and now DAOs, corporations that exist on the internet. Haven't even mentioned generating income from crypto through staking and lending. It's all pretty exciting, isn't it? But in the last 2 years, 46,000 Americans lost $1 billion to crypto frauds and scams, according to the FTC. And quite frankly, I blame that on Gary Gensler. The fact that the SEC has refused to allow a Bitcoin ETF has prevented most financial service firms from engaging in crypto. You said it yourself in the polling, the number one reason that your firm is not engaging in digital assets is regulatory uncertainty. 75% of you said that. This is the message we get from everybody everywhere. We don't know what the rules of the road are, and therefore we don't know how to proceed. Therefore, we don't. I get it. It makes sense. ETFs are the most popular investment platform in the country. Investment advisors and brokerage firms use them relentlessly. The biggest financial companies are all releasing them: State Street, BlackRock through iShares, Fidelity, Vanguard, Schwab, all the ETF and mutual fund companies. It's a multi-trillion-dollar industry, and yet there isn't a Bitcoin ETF on the market. And so most advisors say, that's what I'm waiting for. Until one of those is available, I'm not engaging with my clients. So guess what happens when your client calls you on the phone and you won't help them? You're not stopping them from buying crypto. They're buying. They're going somewhere else. And Lord knows what will happen to them when they go there, because they're dealing with somebody on the internet they may not know who could very likely be operating a scam. And that is the problem. There are so many frauds and abuses in every market sector. We see these schemes in real estate, gold, oil, stocks, and bonds, and now, of course, crypto, because crooks know how to exploit the get rich quick and the fear of missing out attitudes of hapless neophyte investors. And when the financial services industry does not engage to allocate for their client, to serve their client, the clients are going to go somewhere else. We're not only losing market share, we're setting our clients up for economic problem. And remember those millionaire millennials I told you about? 83% of them owning crypto? More than half of them have more than half of their money in crypto. Well, they're not millionaires anymore, because in the past year, crypto prices are down 70%, as you well know. These people invested far too much of their money because they didn't have a financial advisor guiding them and supporting them, keeping them limited to a low single-digit allocation. This is the fault of the regulators, and it's the fault of the industry of not getting engaged. And that's the bottom line. We must engage for the benefit and protection of the American investing public. I get the challenges and the risks and the flip side that exists. There's no regulatory clarity. Firms don't have any inside knowledge on this. How many people in your company know anything about crypto? There's no in-house training being provided to anybody, and there are a lot of risks. You're afraid if you engage, risks to your reputation, risks to revenue if clients fire you over this. You're afraid that if you say yes and it blows up, you could yourself get fired over this. So I understand the risks that are holding people back, but look at the flip side. If you maturely, responsibly, carefully, and with full compliance, engage in this, your firm will actually attract more clients and more AUM. You'll actually attract more advisors. Not a week goes by that an advisor doesn't come to me asking, Rick, do you know of a firm that I can join that will let me recommend crypto to my clients? Because most firms are saying no right now. If you don't engage, your firm's going to lose clients, advisors, and AUM, ultimately reputation and market cap as well. We don't have a choice but to figure out how to do that. And so let me share with you how you can craft a crypto strategy. It's got to conform to compliance. That's a given. And it's got to be consistent with your firm's culture. 4 simple steps: HR, compliance, investment committee, and sales and marketing. HR's got to make sure the training is being provided internally to your firm so that those engaged in this understand, what is crypto? Why should you care? How does it work? What's the investment thesis? How do you build a portfolio? How do you fit it into a financial plan? You do this for every other asset class: stocks, bonds, gold, foreign securities, commodities, natural resources, tech. You do this in every asset class. You do it with annuities. You do it with private placements. We need to do this for crypto as well. In fact, one of the most popular courses that we teach at DAC-FP, that's all we are at the Digital Assets Council of Financial Professionals. We're a crypto education company. It's all we do. And one of the most popular courses we teach is how to build your business by hating crypto. So it has nothing to do with recommending Bitcoin or even liking it. It simply has to do with understanding it so that you can effectively counsel your client. We'll talk more about that in a bit. In the compliance department, should you limit how much a client can allocate to crypto? Should you require the clients meet certain qualifications, meaning a certain net worth or account balance? Should you require clients to sign a disclosure or a waiver? In the investment committee, you've got to establish your due diligence process for crypto and design the suite of products that will be available to your advisors so that they don't run off the reservation. And most importantly, do not alter your firm to fit crypto. Totally unnecessary, backwards, and inappropriate. Fit crypto into your firm. If you can't find a methodology for crypto that fits within your firm's culture or methodology, then you say no to it. But here's the neat thing. Crypto has really grown up in the past 3 or 4 years. Whatever your asset management style, there is a crypto allocation available to you. You like to trade individual stocks? There are Bitcoin mining stocks. There are proxy stocks whose stock prices move with crypto. There are over-the-counter securities that allow you to buy individual digital assets. There are now a wide variety of ETFs if you like to use them in your portfolio. These aren't buying crypto, they're buying stocks of companies that are engaged in the crypto industry, such as NVIDIA, which makes the computer chips that go into the mining operation, or IBM, which has a big blockchain business, or Silvergate, which is the biggest digital bank serving crypto, or Coinbase, the biggest digital assets exchange publicly traded. There are dozens of ETFs offered from some of the biggest companies, not on this list, BlackRock and Schwab. There's a variety of stock ETFs that have a crypto allocation inside it, anywhere from 1 to a third of the portfolio. There are Bitcoin futures ETFs. There are separately managed accounts and TAMPs available for wealthy clients. There are private placements available. If you have clients who invest with IRA money, there are now qualified custodians that allow you to invest crypto in the IRA and in the 401k. I went through that list really fast. You can get the full list up to date at our yellow pages at dacfp.com. It has not only all the companies that are providing crypto investments, but also all the service providers, the news services and the tax trackers for portfolio management, for estate attorneys and accountants that are providing services in this space. It's all available for free at our yellow pages at dacfp.com. And then finally, in sales and marketing, you've got to make sure your client communication is compliant as well as consistent on a firm level. You've got to make sure that your advisors are trained. You might even require that they show proficiency before they're allowed to begin talking about this to clients, because it has nothing to do with recommending digital assets. When a client is coming in to meet with their advisor on their typical quarterly or annual review, the advisor says, hey, tell me about your cash reserves, your 401k, your life insurance, your annuities, your rental properties. As your advisor, I didn't sell you any of that, but I need to know about it because I want to factor it into your financial plan to make sure that the recommendations I give you are correct and current for your circumstances. I didn't recommend any of that to you. I'm not necessarily endorsing it, but I need to know if you own this stuff. When did you buy it? Where is it? How much is invested? Do you have any debt on it? Etc. Tell me about your digital assets. It's not a question of whether I like it or not. I just want to make sure you're not overweighted. You don't own too much of it, that you're not over-concentrated with too few exposures, that you're not taking excessive risks in what is already a risky thing to do, that you're not using unsafe assets like Dogecoin or using an unsafe platform like something overseas. You want to make sure your estate planning is intact. You're not registering your ownership of this incorrectly, that you're not paying taxes unnecessarily on this. There's a lot that we could be doing that has nothing to do with liking Bitcoin or recommending it. It simply acknowledges that this is an asset class that investors are really interested in, and we need to make sure we're handling this correctly, compliance safe, that supports your firm's reputation, that attracts clients and assets rather than drives them away. Because quite frankly, we're treating crypto like beer during the era of prohibition. And prohibition didn't stop anybody from drinking. It just chased everybody into speakeasies where they overpaid for rot gut and they got sick. We need to bring it into the firm. And if we know how to do this, it isn't scary at all. And the fact that every major Wall Street firm is engaging in this, now making it available to their clients, we can't sit back. Remember, I told you there's $1 trillion in crypto assets. That's 10 billion in AUM fees. You really want to deny the firm all that? And to help you learn more, to help you train your staff, because most firms don't have the in-house knowledge, That's why I created DAC-FP 6 years ago, to serve as a crypto education company for the financial services industry. And we've created the certificate in blockchain and digital assets. It's an online, self-paced, self-study course with a world-class faculty. Scott Stornetta, the co-inventor of blockchains, on the faculty. Anders Bronworth from MIT and the Boston Fed, all on our faculty. You get 13 CE credits. First half of the course, all about the tech. What is Bitcoin? What is blockchain? How does it work? And the other half is all about practice management, investment thesis, portfolio construction, regulation, compliance, taxation. How do you talk to clients about this? And through IAA, you're entitled to a 10% discount. The course is just $649. It's really inexpensive. And you save 10% when you enroll using the code IAA10. We're really excited about our partnership with the Investment Advisor Association and getting you this content. And I also encourage you to read my brand new bestseller, The Truth About Crypto. We're finding a lot of firms are giving the book out in bulk to their clients and their staffs because it's a great way to get people up to speed really quickly and inexpensively. So I hope you'll take advantage of that as well. And of course, the most important slide of all is the final slide. You can reach us at dacfp.com. And with that, I'll turn it back to you, William, and we'll do some Q&A.
All right. Well, thank you, Rick. This was wonderful. I know I learned a lot, and hopefully the audience did as well. As Rick said, please feel free to put questions in the chat or use the Q&A function. I'll definitely make sure to monitor both. But just to get us started, Rick, I know you talked a lot about, training and education, and obviously DAC-FP, and you're doing a wonderful job. But, sometimes the question I get, both from members and outside the IA, is how much do I need to know? Do I need to be an expert on blockchain? Do I need to know what a smart contract is, what an oracle is? How deep do I have to go? I think is a lot of times the question I receive.
Yeah, and it's a really good question. You do not need to become an expert at this. You need to become conversant, just as you are. The level of knowledge you have about stocks, bonds, annuities, that's about the level of knowledge you need here. Most firms, most advisors are not trading individual stocks for their clients. They're buying what we call packaged products. You're buying ETFs, mutual funds, annuities. So you don't need to watch Jim Cramer all day long. It doesn't matter what's happening to an individual stock. That's not really relevant. And it really doesn't matter what's happening to an individual stock today, because we tend to be long-term investors. We're investing for years, decades, and we're building highly diversified portfolios. So what you really need is simply the basics on the fundamental elements of the technology. What is it? Why should I care? How does it work? How do you allocate? How much should we allocate? And how do you do it? What are the tax rules, for example? The tax rules for annuities and life insurance, for bonds and for stocks, and for mutual funds and ETFs. You understand about capital gain distributions in an ETF and a mutual fund every year. You need to be knowledgeable about it, just like you are any other asset class. The crazy thing here, William, is that this is such a brand new asset class that has nothing in common with the traditional financial assets of stocks, bonds, commodities, and options, that most of us have no background in it, no training in it. I don't care how many college degrees you've got or professional designations, whether you're a CFP or a CFA or a JD or a CPA, nowhere have you gotten any education about crypto, because it's totally brand new and different, just like the internet was totally brand new and different 30 years ago. So you'll discover that it isn't difficult to get up to speed. This conversation is not complicated. There really isn't all that much to learn. And frankly, going through our course is going to teach you everything you need to know so that you are conversational and you're able to give your client the guidance that they need. This is why the course is so popular. We're now pushing 3,000 professionals who have enrolled in the course. Only 40% of them are advisors. The other 60% are all management. They're all home office staff who recognize they need this knowledge to be able to do their job. And we have people from 8 countries who have enrolled in the course. So it's really, really popular. You'll really enjoy it. And you'll discover this isn't so hard to comprehend, isn't a big lift at all.
Great. Well, no, and that's incredibly helpful, right? Because again, I think it's the question I get most is, do I have to be an expert? And I think,
well, here's the funniest part of the whole thing, William, is that, we all need CE credits. Everybody is always clamoring for the credits we need every year, but do you really need to go to another webinar on annuities? I think we all know everything there is to know about annuities. Well, here comes along something totally new and different. If nothing else, it's intellectually interesting, and you'll get 13 CE credits through the course. So what's not to love?
Absolutely. Yeah, again, audience, feel free, use the Q&A, the chat box. I'm going to take this opportunity since I have you, Rick. Another one of the questions I get, we do have a lot of firms, a lot of advisors that are very ESG focused, and environmentally focused. The SEC just put out climate risk related rules, both for public issuers, but also investment advisors. Historically, Bitcoin has been kind of seen as almost anti-ESG, a lot of very energy consumption. We just have what they call the Ethereum merge that did decrease its carbon footprint, I think by over 99%, which was pretty incredible. Do you see more digital assets going this way, kind of, aligning themselves with this kind of more, environmentally focused path?
So let me break it down for you. For those who are unfamiliar, there are basically 2 main ways that digital assets get invented or created. I mean, we know how stocks get created. A company does an IPO, and we know how gold gets discovered. We put a shovel in the ground, and we pull gold out of the ground. We pull coal out of the ground. We understand how that happens. How does a Bitcoin get created? It's called mining. And because it's a reference to gold mining. And the way that it works is rather simple. You hook up your computer to the internet, you connect to the Bitcoin blockchain, and you solve a computer puzzle, a computer algorithm. And everybody's trying to solve this puzzle because whoever solves the puzzle first is rewarded by getting new Bitcoin. That puzzle solving activity is what authenticates the data that is placed onto the blockchain. And to incentivize you to participate in this activity, whoever does it first, so you're in a race to solve the puzzle, is rewarded with new Bitcoin. 6.25 is how many you get. Now they're 20 grand a piece, so you're talking about $125,000 to solve the puzzle. And somebody wins this reward every 10 minutes. That's a big incentive to engage in Bitcoin mining. But think about this. I got my computer doing it. You got your computer doing it. There are hundreds of thousands, millions of computers all around the world being used to solve these puzzles because the economic reward is so high. Well, all of those computers are burning an awful lot of energy. And this is the criticism, William, that you mentioned, that Bitcoin is bad for the planet because it's burning a lot of energy. So I have 2 answers for you about that. First, there's a lot of research done to determine exactly how much energy Bitcoin is burning. Cambridge is widely regarded as doing the most authoritative, objective review. They just came out with their 2022 report. They said Bitcoin's energy usage is equal to 0.5% of the total world energy usage. 0.5 of 1%, pretty small number. Gold, by contrast, is doing 4 times as much, 2%. So before you complain about Bitcoin mining, you ought to complain about gold mining. At least Bitcoin has more commercial application than gold does. So on the one hand, it's really not burning all that much energy. More importantly, it's not a question of how much energy do you burn. How much of it is throwing CO2 emissions into the air? That's what's bad for the climate. It's not burning energy. We use water power, we use solar, we use wind power. They use energy too, but nobody cares because it's not harmful to the ecology. And that's where Bitcoin is. About, it depends on who you ask. The Bitcoin Mining Alliance says 2/3. Cambridge says about half of all the Bitcoin mining is green. So it really isn't damaging the environment the way that you fear. But it is still, no doubt about it, an energy hog. That's where the other kind of crypto creation comes about. It's not mining, it's staking. And in staking, it uses a different technology. I'm not going to bother getting into the details. I'll simply say this. As you noted, William, it is 99.9% less energy invasive. Staking uses a totally different tech. It's kind of the difference between a gas car and an electric car. Totally different tech. And because of that difference in tech, a different impact on the environment. So Ethereum, which used to be mining, as you noted, they did this thing called the merge last month where they converted from mining to staking, and they cut their energy usage almost to zero. So either go ahead and use Bitcoin with the attitude, it's 0.5% of the global energy usage, half of which is green, or instead of buying Bitcoin, buy Ethereum, which is totally green. Will others shift that, will they go from mining to staking? I doubt it. There are other features and benefits associated with both. And different coins have different goals and objectives. They have different uses. They have different purposes. And they will change. They'll all make their own decision. Some of us are going to drive electric cars, already are. Some of us never will, kicking and screaming. I'm going to be driving my hot rod. So Bitcoin and Ethereum, staking and mining will, I think, coexist forever.
Got it. Well, that's incredibly helpful. And I think your point about kind of looking at the total metrics of how much energy is actually consumed and CO2 is put into the atmosphere, I think it's really helpful for those folks who kind of do hear those headlines.
So here's a fun statistic. Here's a really funny statistic for you. For people who argue that Bitcoin's bad for the planet and turn off all those Bitcoin computers, here's a great statistic. In the United States alone, we burn more energy with always on devices in our house. So before you complain about Bitcoin, unplug your coffee pot.
Yeah, no, I'm definitely on the hook for that. So I love coffee. What can I say? But yeah, so I think that, we have, 7 more minutes. Please keep sending your questions if you have any. I think one thing you've really did a good job of today is kind of understanding the risk landscape. And, another question I've received and something you brought up and, something we saw from the poll, one of the largest reasons for not getting involved in the digital aspect is that compliance risk. How, you see, Mt. Gox from, a decade ago, Terra, I think it was a $60 billion loss, the founders on the run from Interpol. You just have kind of these, really, bad headlines. Just at least as of right now, since we don't have that regulatory clarity, what do you think are some of the ways where, either advisors, management, whoever else in the firm can kind of convince the powers that be to get involved with more digital assets for their clients?
Right. Yeah, it's a really, really valid and important question. And we're doing a lot of consulting to firms, helping them craft their crypto strategy that doesn't create any agita for anybody in the C-suite or the board, or let alone the compliance and legal departments. It is easy to do. That's the good news. So step number 1, you don't want to be first. There's no reason for you to go out on a limb. There's no reason for you to do something that nobody else has done. There's no reason for you to engage in a practice that isn't clear. So that means, frankly, I don't know that I would recommend that a firm tell a client to buy Bitcoin or to assist that they buy Bitcoin today, because how do you do it? What platform do you use? How do you value it? How do you price it? How do you perform the services you're trying to perform within your practice? That's all those questions are up in the air. I don't know that you need to be first in that regard. What you can do instead are invest in securities. You do that already. You do that all day long. There are ETFs that are directionally correct. Individual stocks like MicroStrategy, where the price moves up and down with the price of Bitcoin. There are a wide variety of ETFs. As I showed you earlier, that are investing in publicly traded stocks, Fortune 100 companies that are doing some of their business in the crypto space. These are ordinary ETFs. They're what are called thematic ETFs. You already have thematic ETFs in your portfolio in the approved platform in your firm. You have computer stocks and you have airline stocks, manufacturing stocks, emerging market stocks. You have foreign stock funds. You have all these different ETFs, all these different ETF funds already on your platform. A crypto ETF is just another thematic approach. And if you're going to put low single digits of an allocation in it for only certain kinds of clients for whom it's appropriate, there's no regulatory risk there at all. There's no lack of clarity. Everybody understands how ETFs work. We understand how to buy them. We understand how they're taxed. We understand how to rebalance and dollar cost average and tax loss harvest. We know how to integrate it into a portfolio management system like Tamarack, InvestNet, Orion. We know there's no big deal. It's just an ETF that happens to focus in the crypto space. This is a no-brainer. There's no reason at all. And it scratches the itch. If a client were to come to you saying, I want exposure to crypto, and you were to say, here's how we make it available, I think the client would say, okay, great, go ahead. Just like you're giving me stocks through an ETF and bonds through an ETF and real estate through an ETF, let me have my crypto through an ETF. What's the big deal? That makes it easy to train the staff. It makes it easy to train the advisors. You don't have to create a new tech stack. You don't have to go through any huge hurdles to introduce this within the firm and to introduce this to clients. And yet you'll be able to say to clients, sure, we can make it available if you want. A big question that firms need to answer is, are you going to be passive or active? In other words, are you going to actively go out to clients saying, we recommend you add it? Or are you going to wait and reactively respond to client inquiries? Your choice. Some firms do it one way, other firms do it another way. Some firms limit the number of clients or the types of clients that they'll allocate to. Some limit the amount that they'll allocate. We'll only allocate to a client with $1 million portfolio and only 2% of the portfolio. Things like that. We can help counsel you in all of this so that we take the fear away from this. So you don't have to worry that an SEC examiner is going to raise the question of what are you doing? In fact, I'll turn it on its head for you, William. If you don't allocate to crypto in any way whatsoever, you've got to ask yourself this. When an SEC examiner walks in or a FINRA examiner and says, are you allocating to crypto? And you say, no, they're going to say, why not? You've got to have a good reason. You can't say because it's a fad or a fraud. Neither of those answers are true. You can't say because we don't know anything about it. That doesn't work either. That doesn't meet the fiduciary standard. You've got to be able to demonstrate to regulators that you have carefully evaluated this asset class, just as you have every other asset class, and here are the reasons that you do or don't allocate. Here are the circumstances under which you do allocate. To what kind of a client? To what extent? Under what circumstances? And in what way? You need to do your job. Failing to allocate will increasingly be under scrutiny as much as allocating. You've got to be able to explain the thesis under which you've made your decision of yes or no. And right now, most firms are not doing that. And we can be really helpful to you in that effort.
Yeah, no, and I think that's a great point, is a lot of times, even myself, I don't really think about that reverse, is that, yeah, we can always say, hey, we're not doing it, we don't care about it, but at the same time, you need to have kind of those, that reasoning behind it if you're asked, for sure. So, and either that could be your regulator interest or client interest, because as you said, it's going to happen. So, I was a bit surprised by the millennial numbers, but I guess I shouldn't be.
Let me tell you, can I share a story with you? I know we've got.
Yeah, no, of course we got another minute, so story away.
An advisor came to me a couple of weeks ago and told me a horrible story. His client invested $100,000 in crypto. He didn't do it through the firm because the firm wouldn't allow it. So the guy went and did it on his own. He found a crypto advisor in London, and he gave him $100,000. The guy promised him that he would turn the 100,000 into $1 million in 90 days. 90 days went by, and he called the guy on the phone and said, we got great news for you. Your account now is $1 million, but we're worried about crypto. We want to sell the account and send you your money. But in order to do that, we're in the UK, there's a VAT, a value added tax. We can't liquidate the account until we pay the tax. You need to send us $300,000 for the 30% VAT tax. You know where this is going.
Yeah, I have an idea. Yeah.
So the guy calls his advisor here in the US and says, I need to liquidate 300 grand and here's why. And at that point, the advisor said, I got bad news for you. You're being scammed. So the failure of the advisor to protect him of his original 100 grand, because he wouldn't allocate within his portfolio, set this guy on the course to searching the internet, winding up with a scam artist in London. This is what we as an industry have to protect against. And that's why I'm on the soapbox so that we can do this.
Yeah, well, it's a great soapbox to be on, especially, I mean, that story really is a great way to end it, because it really shows just being educated and educating our clients can just really go a long way to protecting them. And I think obviously that's, what advisors, are trying to do and act in their best interest. So we are at time. Rick, thank you so much. This was wonderful. I know I learned a lot. And I know the audience, I'm sure, did too. And hopefully you'll come back and talk to us and talk to our members, because I just think this, as you said, this is going to be an issue that just keeps growing and growing and growing in importance. So thank you so much.
That's my pleasure, William. Thanks so much for the honor of being here. Let me know how I can help you. I'm happy to do it.
Absolutely. All right. Well, everyone, have a great afternoon, and we'll talk to you later.